Good morning, everybody. Welcome to this TreasuryONE and ETF Analytics webinar, where we're going to discuss what's happening in the world. It's now week 25 of the war in Iran. It's still very prevalent. Before we get into that, I'll just have some housekeeping rules. If you've got any questions, we'll answer them as we go along. There's a comment section on the right hand side where you can just ask any questions and we'll get to them as we go along. We'll stop George and his presentation. We'll try and keep it short and informative. But yeah, I'm not going to speak too much. I'm going to hand over to the head of research at ETM and George Glynos to tell us about the world. Obviously, the world's all about what's happening in the oil markets. Then it's wars on, then the wars off, then oil's up, then oil's down, then the rand's weaker, then the rand's stronger. Then we raise interest rates, and we're going to cut interest rates. So it's all about oil, it's about interest rates, and how that all flows into economic growth and what's happening in the local currency, not only in the local currency, but what's happening in the US dollar. Part of that, I'm just going to touch on it, is equity markets is still booming. So the world's still a happy place, still a lot of AI spending out there. But I'm going to hand over to George to give us a little bit of color what's happening, and then more than welcome to ask any questions. George, over to you.
Thank you, Wichard. As you quite rightly said, it's a world where the news flow is as volatile as the markets, in fact, more so. So it's difficult to try and keep up. And if I can just say, I'll apologize in advance because I updated all my charts late yesterday afternoon, evening, and by this morning already some of them had changed, to give you some perspective as to how quickly things have moved around. And I just really haven't had the time this morning to go and update a whole bunch of charts any further. But I thought it would just be a good idea to start off by giving you guys some perspective as to some of that volatility, some of the latest information that we have on what's going on. Obviously, it still centers around what's happening in the Strait of Hormuz and whether or not we have a deal or not have a deal. And we've seen President Trump acting very bullishly about how he is going to continue to attack Iran and do so in a very aggressive manner until such time as they come to the negotiating table. They've pushed back, so it's gone backwards and forwards, backwards and forwards. We've had bombing in Iran. We've had Iran bombing, some of the US military bases in the neighboring Gulf countries. So it's been backwards and forwards. There are varying reports as to how far this has gone and why the pause now. There's some reports suggesting that both sides are starting to run out of munitions, which is quite funny. So they've chucked so much at each other that they're now starting to dig very deep in terms of their supplies and their abilities to continue launching missiles and drones at each other. But such is the nature of war. You're going to get these. It's almost breeds. You get these periods of aggressive attack and then getting pulled back again. And at the moment, we're in a state of pullback. The thing is, we've been down this road several times now in this war. And so I'm considering it to be somewhat fragile as a ceasefire or as some sort of an agreement, because we haven't as yet heard from the Iranians whether they are prepared to accept the US terms. Which is essentially full disarmament on the nuclear side of things and reopening the Strait of Hormuz completely. The chart on the left shows you very clearly that the amount of tankers passing through the Strait of Hormuz is right down near the bottom. I mean, it's improved slightly, and it had improved at some point when we had opened up for the peace deal that was originally signed a couple of weeks back, but it's pulled back down again. The problem with this data is that they are guesstimates, if you like. There are many people that are trying to understand the movements through the Strait of Hormuz, but very few have hard and fast data. The US military says one thing, guys with satellites say another thing, Iran says a third thing, the Gulf countries are somehow still pushing crude through somewhere, and it's not, and it's beyond just the pipelines that they have. So there's oil getting out, and perhaps more so than is reflected in the chart on the left, but it's obviously problematic. And we know that it's problematic because the chart on the right gives you a clear sense of what's happened to shipping prices. Well, quite clearly, shipping's been disrupted. You've got some ships that are still sitting with tons of oil on them and can't dock, either because they're sanctioned or because they're inside the Strait of Hormuz. And you've got others that are waiting on the outside of the Strait of Hormuz that are trying to get in. So you've got a relative scarcity that's sprung up, and that scarcity tells us that the market is far from having normalized. So as the title says, we have a deal, maybe not. This has been the story of the past few months, and it's quite nicely reflected in the chart on the left, where you see a lot of the volatility. Whether you look at crude, gas, natural gas, all of them are moving in similar type of fashion, but with a high degree of volatility compared to how they used to move prior to the war. And you can see that massive volatility coming in as the war began at the end of February. Suddenly, these markets just launch higher. Equally, we've had a lot of volatility in the way that futures oil prices are trading. The chart on the right gives you a sense of the degree of backwardation, no longer quite as extensive as it was at the peak of the war, nevertheless still there. We were at some point trading almost like a normal curve, but alas, that didn't last very long. That was when they thought that a peace deal would get signed, and oil prices went all the way down into the low 70s, and suddenly we started toying with a normally priced futures curve, but that didn't last long. So we're back to mild backwardation. Clearly, the market still anticipates some sort of resolution to this crisis, and as a result of that, we are monitoring that as carefully as we can. Wichard and I were having a discussion before this, and he was telling me, there's been a lot of drawdown, and he doesn't know what to believe anymore. And I can sympathize with him, because there are several sources of information that one can tap into trying to understand the full implications of what's going on in the oil market, and how we should be thinking about it. So I thought that I would pick up on some data produced by the EIA. The EIA has obviously got very strong ties to the US administration, and so I take their data pretty seriously. It's about as official as you're going to get. The data that they've got shows us very clearly that there's been a very strong draw on crude inventories of roughly, at the peak, approaching 7 million barrels per day. So there's a shortfall of roughly 7 million barrels per day that's been made up by essentially the US, Japan, and one or two other countries that have released some of their strategic reserves, and they've done so in order to try and contain oil prices. Wichard was saying that they are manipulating the short end of the oil curve. I mean, that's essentially what their objective is. Their objective is to try and keep oil prices as low as possible. And by definition, if they can talk the market into believing that there's going to be a peace resolution, then the futures prices of the oil market is going to come down quite a bit. The problem that we have here is that there's been such a big disruption. If I'd shown you the chart on the left a month or so, or even two and a half months ago, you would have seen this big spike up originally, and a spike straight back down again. In other words, the draw on strategic fuel reserves would have been short and sharp. Now what we've seen is that short and sharp, which was supposed to end in June, has now been pushed all the way out to October and November. In other words, they're anticipating that there's going to be a draw on inventories that pushes way out into the year still. And the reason that's the case is because the degree of disruption that has been inflicted on the region. Recall that it's not just about whether facilities get bombed and whether ships are moving in and out. Oil producers have to store the stuff. At some point, they start running out of capacity, so they slow down their oil production. But to increase their oil production again is not just a flick of a switch or a turning up of a volume button. It takes a long, long time to do so. In the interim, you've got subdued levels of oil supply into the market, and of course, that doesn't necessarily match up with global demand. And so whilst you get that shortfall between the supply and the demand, you've got to meet that somehow. And so this is the inventory draw that we're seeing at the moment. That gives you a sense of the shortfall, the chart on the left. The chart on the right gives you a sense of the petroleum stock levels that they've got. And you can see that it's dropped very, very sharply. So back in 2020, we had, of course, COVID, and that dealt a very big impact because there was all sorts of shutdowns of production and whatnot that took place there. We also had other disruptions at the time, but quite clearly the most recent disruption has been this war that we've seen the latest tick down in the chart on the right. And at the pace that we are ticking down right now, very quickly, if we don't get this war resolved, by around about August, September, we're going to be talking about strategic reserves that are heavily depleted compared to where they were. You'd have to go back many, many decades to get to levels that those strategic reserves will be. Now, here's the problem with that. When those strategic reserves drop too far, those countries that hold those reserves are going to start being less accommodating of the market and are going to want to start holding some of that back for their own country's purposes. And so a relative scarcity is still a risk factor if this war doesn't get resolved and get resolved soon. So we're talking about a figure of 1.5 to 2 billion barrels that have been lost in cumulative storage through the course of this war, and that is not entirely reflected in the chart on the right. Part of it is, but part of it is also reflected in the drawdown, which we don't have, of corporates that have drawn down on their own stock levels and inventories. The loss in production, you're talking about demand destruction that's also taken place. All of that together has amounted to roughly so far just over 1 billion barrels, and if it carries on, we're going to be talking about figures 50% plus higher than that. So that's a very significant amount, and it's a significant impact to the overall market. One of the reasons why the world has been able to cope with this without just without having oil prices going to $140, $150 a barrel, in other words, without the oil price just adjusting in the way that it might have in a position of scarcity, well, we've had several countervailing pressures that have come about. Firstly, you had the likes of Saudi and the UAE that ramped up use of their pipelines, the east-west and the west-east pipelines for the UAE. So they combined are probably pushing out some 8 to 8.5 million barrels per day of the roughly 15 to 18 that was lost during the war. Then you've had the drawdown, which has been anywhere between 5 and 8 million barrels per day. That's on the inventories, and the rest has come through demand destruction. More recently, we've had a ramp up in production by the likes of Brazil, Venezuela, Nigeria. America has also ramped up a little bit more. So the combination of that has kept the oil price well contained. Part of that demand destruction was also reflected in some of the Chinese data, and the Chinese have been importing less oil. And so you've got the Chinese that have started to draw down on their own strategic reserves to make sure that their teapot refineries are still well supplied with oil, and that China as a whole doesn't have to deal with any of these supply disruptions. But the supply disruptions have been there, and there's no doubt about that. And so it stretches beyond just the oil prices. We know that Gas supplies have also been heavily impacted, and those gas supplies have impacted the price of fertilizers. And as of July the 31st, as I said, a couple of days can make a big difference in these markets at the moment with the level of volatility that we're with. But as of July the 31st, gas prices were substantially higher, as you can see from the chart on the left with the blue label. That's where July 31st the gas prices stood. You can see a fair amount of backwardation still in the market, but the prices are high. And so naturally, it follows that the inflationary impact is going to be fairly severe. You can see that in the spike on the right-hand side. And naturally, when it comes back to South Africa, that spills over. So there's a supply shock that's hit the world. But in terms of painting a picture for you on what that means for South Africa, well, we've had that inflation impact hit quite hard and sharp, short and sharp. And so on the chart on the right, you'll see that much of that has come through through the diesel and petrol prices that we've all experienced at the pumps. You can see that overlaid with the CPI, which is the yellow line, and how the two have moved together. Not much that you can do about that, unfortunately, and so it therefore also pays attention to consider, well, then what next? And so when we're looking at what next, we like to look at our inflation risk index. That's the chart on the left. That inflation risk index is obviously well elevated in the blue line. We're hoping that if this war ends and ends soon, that blue line comes back down again. So that gives us a lead on the momentum behind inflation. At the moment, the momentum behind inflation is still quite strong. It brings us to questions around the Reserve Bank's decisions and whether or not that was the right thing to do, to pause at this point when, well, our data shows that there's still upside risks to inflation that are going to last a little bit longer. And you really are gambling in your belief that this war is definitely going to end. I think, I don't know what the last count was, but there were 7 or 8 attempts by the US to end this war and enter negotiations, and they all failed. Trump has tried on several occasions to talk it down. It has failed, and so it's difficult to take him at face value. So,
George, sorry, I just want to quickly interrupt you. You talked about oil prices now. You talk about inflation, still upward pressure. And we listened to our governor when he said we're not raising interest rates because we're going to try and stimulate growth, and I think inflation expectations is going to come down in future. Obviously, you're going to talk about the FRA curve now, and then we can talk about the rand that weakened dramatically after the SARB announcement. But wasn't the SARB announcement came in a little bit of a perfect storm when oil prices were pushing $100 a barrel again? The yen carry trade we talk about now is very relevant. So surprised the market, but markets weren't positioned for it. There were some M&A activities behind it. So like a triple whammy that have caused the rand to weaken. And I mean, like we see this morning, nothing much has changed except oil prices come back, but the rand's come back 60 cents again. Sorry, if you just could talk about that a little bit. Sorry.
Yeah, absolutely. So you're quite right to point that the backdrop out, but just remember that backdrop in at the time was largely known to them. They knew that there was an intensification in what was going on in the war. They would have known about the inflationary impact. They also would have known just by looking at things like the FRA curves, what the market had been pricing in. So they would have gone into that decision knowing full well that the market was anticipating a 25 basis point hike. They knew full well that oil prices were pushing higher. They didn't know that there would be efforts towards a peace deal. And they also knew that there were other central banks around the world that were talking about lifting interest rates further. So I do have to question the logic that the SARB applied. The chart on the right shows you that inflation expectations were starting to push back up again. Unfortunately, those are quarterly, so we don't know what the second quarter figures for that are. And unfortunately, we're sitting in a position right now where we really are at the mercy of what happens in the Middle East. We may get lucky. And the war ends, and things calm back down again. The rand recovers. Quite rightly, you pointed out it's been moving very closely with the oil price. And that makes a lot of logical sense. It impacts the terms of trade, it impacts the trade balance, it impacts cross-border flows, it impacts inflation. All of those sorts of things feed into a currency price. And so that the rand has pulled stronger again with the oil price coming off absolutely makes a lot of sense. But do we trust it? That's the question. Is this time the time when we get a deal? If it is, happy days, then we can all just settle down, calm down, and carry on with our lives. If it isn't, what you risk is that you fall behind the curve. And by falling behind the curve, I'm saying you're letting the market and inflation dictate future moves rather than trying to gain some measure of control, both of the narrative as well as markets, by saying, no, we're not going to allow this to get out of hand. We're going to act preemptively to make sure, buy a little bit of insurance that inflation is not going to be a factor that we need to contend with down the line. I remind people that 25 basis points doesn't make a huge amount of difference in the way that an economy functions. A rand that's weakening substantially or has a high degree of volatility impacts, proportionately speaking, more. So you got to weigh up. Yes, we might pay 25 basis points less, but if the cost of that is going to be additional volatility in your currency, it's not always a great idea to go that route, even though you might be able to sell it to households more easily. If I have a look at this particular chart, Wichard, it's starting to show, and again, if I'd shown you this chart at the beginning of the year, most of this would have been green. But you're seeing a lot of central banks now that are hiking. And you can see that it's all recent, because in the months since the last hike, you can see that those numbers are still quite small. So most of these central banks have been hiking more recently. It changes the dynamics of things like carry trades and the way that South Africa might stand out relative to other emerging markets out there or other developed markets out there. And unfortunately, South Africa, because of its many structural issues, naturally has to carry higher levels of interest rates to make sure that we're still able to attract the level of foreign capital we need to make sure the rand is stable and that inflation remains under control. Into another development that happened recently, which I think is worth talking about, because whilst we're talking about carry trades, etc., the pivotal center point of carry trades, and it has been the case for a long time now, you're talking decades, has been what the yen has been doing. The yen has traditionally always been seen as a funding currency, partly because, as you see on the chart on the right, your real interest rates there are permanently negative, or they have been for many, many years now. And you're talking again over a decade that you've been sitting with zero or negative real rates in Japan. The interest rates traditionally are substantially lower than they are in many other countries around the world. The result of that has been a steady weakening bias that's been evident on the yen, except that is having knock-on impacts all over the place, from inflation to skewing its trade data and affecting some of its trading partners, etc. So for a host of reasons, Japan has decided that now is the time that they need to try and normalize monetary policy. And so the chart on the left gives you a sense of their efforts to jack up interest rates. It's the highest rates that they've had in decades. Again, that blue line is their official rate. The black line is your 10-year yield, and you can see how that has spiked. Now, all of a sudden, if you're borrowing in Japanese markets to go and buy assets abroad, this starts to matter because it raises the cost of carry. The objective, of course, is to try and make sure that they help the yen, prevent it from continuously weakening, because it's creating issues of its own. And through the course of the past week, we had what they called a massive intervention in the yen. The Bank of Japan got together with the Federal Reserve. They That triggered some swap lines because Japan didn't want to offload all of its reserves, and there's very good reasons why they wouldn't want to do that. But essentially, their reserves did still drop, and drop reasonably sharply. That's the blue line, only to generate that small little downtick that you see in the black line, which is the dollar yen. So quite clearly, there's an underlying bias here towards a weaker yen, and that's not going to change easily. The Fed and the Bank of Japan have been very, very vocal over the past couple of days, saying that they will do whatever is necessary and they will make sure that the yen doesn't weaken substantially further. What's in it for the Fed is that they don't want the Japanese authorities offloading $1.2 trillion worth of US treasuries for a very simple reason. US treasuries are sitting at very elevated levels following the Fed's most recent decision, which was also to hold rates unchanged. The middle to longer dated bond yields ticked higher, which in effect was almost like a rate hike of a different sort in America. And if anything, it would help undermine some of their credit cycle, partly because corporates and those that are applying for new bonds and whatnot on homes are going to be paying proportionately more for borrowing that money.
Sorry, George, can I quickly ask you something again? So
yes,
you talk about the intervention from the Federal Reserve, but they sold some of the euro reserves to prop up the yen. Why is that? To keep why would the reason be selling euro reserves to prop up the yen? And then secondly, Kevin Walsh, although he hasn't stated it, isn't he advocating for a more steeper yield curve? And he doesn't mind, like you just said, doesn't mind the longer dated yields going up because it does the monitoring tightening for him, where he doesn't have to do the rate hike, but the longer end does the work for him. So the market does the work for him.
Yeah, I mean, let me answer the second question first. So there are knock-on implications to doing that. So he might be fairly comfortable that the short end of the curve is well anchored, and that the steepening of the curve helps promote a credit cycle in the sense that banks borrow in the short end and they lend longer term. So they become more stable and profitable, and so they're encouraged to try and push more credit out there, and that's the kind of logic that exists. Except that he's trying to do that at the very end of a credit cycle, not the beginning of a credit cycle, and certainly not even in the middle. So he's doing it at the end, which means that there is risk to doing that, and there's risk to doing that for a couple of reasons. And I do have a chart in here just to remind people what the credit cycle in America looks like. But the problem that he's going to face is if inflation doesn't come under control and he is forced to jack up interest rates or to be more conservative for a longer period of time, then that steepening that we're getting at the moment is going to start turning into flattening, which is one of the first signals of a softening economy, which is exactly what he was hired not to engineer. So he's going to have to try and maneuver this very, very carefully with regards to Trump. After all, this is what he was elected for, was to try and ease monetary policy rather than tighten it. And at this point in time, he's accomplished the exact opposite. So yes, he might talk one language. I think what's happening behind the scenes is that he's going to be fearing something a little different. Also, by virtue of the fact that the front end of the curve has remained anchored, what it's probably going to do is force a lot of corporates to borrow at the shorter end, which means that you start front loading your credit cycle as well. At some point in the future, if you have to run a conservative policy or jack up interest rates, if that's what you're forced to do, all of a sudden, what you're faced with is you've brought a longer term problem of high levels of debt, you've brought it forward. It also, bear in mind, impacts fiscal. And so fiscal is another issue that they've got to be mindful of at the Fed. Why? Well, because quite frankly, the Fed has been one of the major drivers or major containers of interest rates at the middle to longer end, so that the government's own budget doesn't blow out. And at the moment, it is blowing out because the Trump administration has had to pay back the customs duties that they collected on all the tariffs that they issued that have now been rolled back. So it's a very complicated it's a complicated monetary environment that they've got to navigate at the moment. Yeah, I'm not sure that what they did was the right decision either. I don't even think that the Fed's own Federal Open Market Committee members felt that it was necessarily the right decision. Certainly not in totality, because it's the biggest split that we've seen in a very, very long time as well. So that's on that front. With regards to Japan and them selling euros, well, I think the answer to that, Wichard, also lies in the fact that they've been very closely aligned and working with what the US authorities are dealing with at the moment. So what the US authorities do not want to see is Japan selling US assets. Most of those assets are US treasuries. If Japan starts to sell those US treasuries aggressively, those 10, 20, 30-year US treasury yields go even higher. And so it just compounds an existing problem. So they have offered the Japanese swap lines. In other words, they will swap yen for US assets at the moment, so that they don't physically have to sell their US assets, and they've been offloading some of their euro assets, I think, because they're not facing that same kind of pressure from the European authorities. And so I think that's what we have at the moment. The problem that the Japanese authorities have is that the yen remains weak. With this amount of intervention, and the yen only moves that tiny little bit that you see in the circle up at the top there, that's problematic. It's problematic in part also because the bond market performance in Japan is not looking good at the moment. That might help promote the carry trade on one level, but it creates a lot of fiscal distress on another. And so there are other reasons beyond just the carry trade that are weakening the yen, and that is concerns about the outlook for Japan's fiscal position. And so, why is this yen such a problem for them? Well, in part because they are now importing inflation, and inflation is becoming more problematic in Japan. So at some point in time, they do have to try and make sure that they contain that imported price of oil, for example. They're very dependent on importation of oil. So this latest shock has not been particularly welcome to them. And so, the carry trade is coming into question. And it's an important question to answer because without that carry trade, there are a number of markets around the world that are going to experience some volatility of their own if they don't have, the same funding currency. This chart, again, updated yesterday, and all of a sudden the Japanese trade balance weakened dramatically, and that was very much an oil price thing related to the war. But in general, the movement in the trade balance with regards to Japan is becoming more neutral. In other words, they're exporting more again. They're starting to nudge back into trade surplus territory. And so naturally, as a result of that, we're anticipating that there may be some justification for the yen to find a little bit of support, although at the moment the market is overwhelmingly focused on the carry and fiscal, and so that's where we're at the moment. So central banks still face this dilemma where they've been keeping interest rates flat, as you see the top two. The Bank of England, the Federal Reserve, they've kept interest rates flat. The ECB's hiked once, but are not likely to go into any aggressive form of tightening. Yet bond yields across the globe are rising, and rising fairly steadily. So this inflation expectation is problematic. Fiscal is becoming problematic. And the fact that monetary policy isn't responding to that in a weird sort of way is becoming problematic for the bond markets as well. Which leads us all into, I thought it would be useful to have a look at our carry attractiveness index to show you where the rand sits relative to the yen, etc. Now, you would expect the yen to be at the bottom, but the yen has always been pinned at the very, very bottom. It's now starting to creep up the rankings. And although it's right down low, and it's right down low because their terms of trade are poor, because their real interest rates are still low, because their adjusted deposit rates are still pretty low. All of those reasons still speak to a carry currency that, or a funding currency that's still going to promote carry trades. The rand is a lot better further up the rankings, so you would expect a little bit of resilience to the rand. But interestingly, there was a point in time where we used to hug the top of these rankings, and we're now kind of like mid-table, which tells us we need to be a little bit cautious about how South Africa considers itself relative to the rest of the world. On the left-hand chart, we've got the yen. I've taken that carry attractiveness index, I've plotted it as a time series versus the EM, emerging market and developed market average, and you can see that the Japanese yen has been below that more recently. On the right-hand chart, you've got the South African rand. It's been above the EM and DM averages. That's what you would expect to see. So there's still an element of it there, but so much of what's going on in this yen carry trade is related, and Wichard alluded to it up front, with what's going on with equity markets, the AI boom in particular. So I thought I'd plot this AI boom relative to other boom cycles that we've seen in the past. The dot-com bubble, you see in blue there, the commodity super cycle in yellow, the crypto bubble that we see in black, just so that you've got some comparison. It's interesting because to me it looks more measured. This AI boom is very powerful and very strong, but it's not yet reached the peaks of the dot-com bubble. It's nowhere near crypto and hasn't even so far surpassed the commodity super cycle. So, if history is anything to go by, given the amount of momentum that's going into AI and the many hundreds of billions of dollars that are being poured into it, I think this year alone, they're talking about investment of approximately 250 odd billion just in America. And that's expected to rise to 300 and over through the course of next year. These are enormous numbers that are naturally going to have a knock-on implications to all associated industries, upstream, both and downstream. And naturally, it's sucking in a lot of capital. It's also, interestingly, sucking that capital away from funds that would otherwise have entered treasury markets, which might also explain why those treasury yields continue to rise up. But I thought it particularly interesting when I have a look at Japanese purchases of these stocks that I get from official data in the US. That's the chart on the right, and that's the blue line, versus the Japanese yen. And have a look at that. So we've got a very interesting dynamic reflected in this right-hand chart. Firstly, we know that the yen carry trade now is being utilized to fund many purchases of AI stocks in America. So there's two things that the Americans and the Japanese would want to try and protect here. The first is the yen. We've already discussed that, and there's obviously been some intervention that's taken place. But the second is the US authorities may be starting to be a little bit concerned about an AI bubble of sorts. And so if they know that at least part of that AI bubble is being funded out of a yen carry trade, well then one of the ways to just take the froth out of that market would be to try and pause that yen carry trade. So there are many reasons why the Americans and the Japanese are working together to try and stop the yen from continuously weaken. And they're both cyclical, financial, and structural. And so for all of these reasons, I think there's a very good reason why they've jumped into that and done what they've done. Again, to remind people that, and this goes back to the point we were making a little bit earlier, Wichard, with regards to Kevin Walsh and the steepening of the yield curve, and I was telling you the concern that I have is that he's doing it, right at the tail end of a credit cycle. Well, our dollar liquidity cycle is looking pretty stretched right now. It's telling us that we're in that kind of zone where you could have some dislocations in global equity markets. This chart does look exaggerated because we're winding out some of the distortions that were created through COVID. So it's exaggerated to the downside, but we're at similar levels if you had to adjust for that to the global financial crisis in terms of dollar liquidity. So there are reasons to be a little bit concerned. How that ultimately all rolls up into the rand is also interesting, and I'll leave you with these last couple of charts, and we can take any questions if there are any. But when we looked at our rand sentiment indicator, we knew that when this war started, that it would impact quite heavily on sentiment, and that people would be very concerned that there would be some sort of a volatility episode in the dollar rand, and rand sentiment weakened quite sharply. That reflects aggressive hedging against rand weakness. That's what that reflects, and we're working through that now. So the rand is still vulnerable in the short term. The good news is that this sentiment indicator has bounced back up, which means people have regained a little bit of faith in the rand's resilience, and that if we do get a significant wobble, that it's more likely to be short term rather than anything structural and long term, which is an important point to make, Wichard, for you guys as well as your clients, because if we do get an episode of rand weakness, your exporters should seriously consider taking advantage of that relatively quickly and not waiting too long. It's also worth pointing out that the environment as it stands right now with the rand back in the 1630s, we're talking about a rand that's back in firm favor of the importers. At this point in time, we're below the lower limit of our stretched valuation metrics, which tells us essentially that these are good levels for importers. We have tended to follow this indicator as a means of guiding when would be a good time and bad time for importers to get in. And you can see that on the right-hand chart. So that's a much longer-term chart to show you, when we get to these very stretched indicators, as you see, the chart on the left is effectively a zoomed-in version of the chart on the right. It has tended to pick some of these troughs reasonably well. So we pay attention to this. It's telling us that these are a good time for importers. When I look at the pound on the left, it's more neutral. So we don't have a strong view either way with regards to the pound. With regards to the euro, slightly more value there for importers than we've been used to for the past few years. So there's something there for people to consider. And I think, Wichard, with that brings me to the end of this presentation, but I'm happy to take any questions from you or anyone else out there.
Yeah, George said there's no questions from anybody out there at the moment. So if anyone's got a question, you're more than welcome to leave it. So George, quick one for you. The possibilities, like we went through all of it for the local currency for the rand, all the risks that you mentioned is more skewed for a bout of rand weakness and maybe a push back to 17 rather than a push back to 15.50, if I understand you correctly.
Yeah, so I'm not saying it can't get to 15.50, but if it did, I would be mopping up as many dollars as I could lay my hands on. That's what I would be doing. In terms of the asymmetry in the risk, those statistical models are telling us that we're right in the tail of rand strength at the moment. So it's telling us that, if you place any value in statistical analysis over a long period of time, it's telling us that the asymmetry is very skewed towards rand weakness. It's almost like we're just waiting for that straw that broke the camel's back to just set something off. And I don't quite know what it is. Maybe it's the war in Iran spreads. I know that the news at the moment is positive, and I really do hope that there's a resolution to the war. But if there isn't, and it turns ugly, that could be a reason. The credit cycle is another reason. The AI bubble is another possible reason. And you know that they're working on the yen carry trade, which has funded some of that AI bubble. So, if momentum leaves that AI industry for some reason or other, and we start to get a meaningful correction in global stock markets, that could prompt a rand weakening substantially. You've got gold and platinum prices. Yes, they're well off their highs, but they are still quite elevated compared to history. In a world where we get some sort of a big correction that takes place, what would the rand look like in that environment? Well, it would look weaker. So, yeah, I'm not a soothsayer, and unfortunately, I don't have a crystal ball that gives me a clean map out to the future. But there are many reasons why there could be some volatility, and I think it's just useful to sometimes pull back the lens. That's why we look at these valuations statistically, is because it pulls all emotion straight out of it, and it looks at just the numbers. And the numbers tell us that the rand at these sorts of levels, yes, there might be good reason for some of the resilience in the rand at the moment, and we can go through those maybe in the next webinar that we host. But there are also a lot of risks that lurk, and the rand has been at these kind of strong or resilient levels now for a while. It's been here for quite a few months now. And so at some point, I think we need to start considering the possibility that there could be an event that triggers, which could take rand a little bit weaker. And if we didn't take advantage of these sorts of levels now, I think for at least for the importers, we may regret it.
Yeah. And then lastly, there's two things. One of the Gary asked, what is the outlook for gold and other commodities? And then Andres asks, what is the one risk that's keeping you up at night that you think we are complacent about?
Yeah, so let me start with the second question. That has been plaguing me for the past couple of months now, actually, and it's the scarcity issue with regards to oil. I want this war resolved so that we can start trying to normalize these oil markets. South Africa is extremely vulnerable to scarcity because we sold a lot of our reserves in 2015. We have half the refining capacity that we used to have. And a huge chunk of what we import for refined fuels comes out of the Persian Gulf. You're talking a significant percentage. So you take all that into consideration. The thing that keeps me up at night is that this war drags on. That by the end of August and September, going into September, and maybe the end of September, when the US decides that it's not prepared to release the amount of oil into the market that it has been releasing, and oil prices start to move significantly higher, that is a risk that keeps me up at night. That is, it's bothering me quite a great deal at the moment. So that's the reason why I would want the war to end. The question around gold is an interesting one because, well, it brings what I've just said into play as well. It brings a global growth picture into consideration because there needs to be demand for the gold price to go. But I'm still a gold bull for the medium to longer term. I'm still a gold bull, and I'm a gold bull because we know that major central banks are still buying gold. I don't have the chart in this pack to show you, but I can assure you that the Chinese are still buying. So the amount of gold that they are holding in terms of reserves, and I'm not talking about in terms of price, I'm talking in terms of tonnage, how much gold, how many ounces they have. That amount is continuing to increase. So they're still buying gold, and they're not alone. There are other central banks that are doing the same thing. In fact, BRICS, more broadly speaking, have been doing that, and I think in a few years' time you're going to see the reasons why, and I think the reasons why is that I still believe that there is an effort afoot to create another digital currency that's going to be backed by the likes of oil and gold, that will be traded very heavily by BRICS countries, which is going to pose a bit of a challenge to the dollar. This is a long-term thing, but it's part of the reasons why I'm still bullish gold, and I think gold as a natural hedge against inflation. Volatility has other uses as well, but there's a scarcity with gold. You know, a lot of people don't realize, but more than half of the gold that exists in the world right now was mined out of South Africa. You know, when you take that into consideration, the fact that we can't mine gold in the way that we used to mine gold, that tells you a great deal about that there is going to be a scarcity factor there that you're not going to get away from. And so for me, a scarcity factor, central banks still rotating towards gold, an inflation episode, I'm still a gold bull, which obviously has implications for South Africa and the rand. That's one of the factors that adds to the rand's resilience. But I think you need to separate your longer term structural factors that drive resilience versus your short term volatility that, you know, peaks and troughs on things like a war, stock markets that wobble, carry trades that unwind, things like that can still impact things in the short term, whilst you can still have, you know, a longer term resilience influence that continues to come through.
George, I say thank you for your time. Interesting volatility still out there with us. If you've got any other questions for myself or for George, or any questions regarding about how do we need to look at your book, please feel free to reach out to us anytime. We'll get back to you as soon as possible. But with that, George, let's hope this war ends. Let's see how it pans out. And yeah, we'll be back in about a month or so with another webinar, and we look forward to that. Thanks, George.
Thanks, everybody. Have a good day.